So good afternoon, everyone. This is part two of week two video, and then I'm gonna share my screen so you can see what we have. Okay, guys, okay. So this is the one that we had a while ago, and then let me just make sure that you can hear me. There you go. So we ended up with the DuPont method, and then we talk about the breakdown of the ROE by return on asset and also financial leverage. Where in return on asset, you can break it down further by looking at it on a profitability and a productivity type of discussion. Productivity as a metric is also what we call asset utilization, right? The turnover of the receivable, inventory, and then accounts payable. Now let me go back to our slide deck, and then it's now the turnover calculation. Let me move my screen here. So wanted to make sure uh, we can actually go through it. So receivable turnover. So when you think about turnover, turnover is one formula, and then there is a period of time formula. So turnover and a period of time. So turnover will be sales divided by receivables. Now here, you can see that there is credit, right? Mentioned here. So when you think about sales, sales can either be collected in cash or sales on account, basically on credit. So in any income statement, if you pull out Apple, Tesla, or any type of financial statement, the sales over there either can be, say, 70% in cash and then 30% in credit, or the other way around. It can be a mix. So that sometimes the book or problems would say all sales are on credit 100%, then you can use that. If they say that 90% of the sales is on credit, then you need to multiply the 90% of the sales because you're going to divide it by receivables, which is technically what is outstanding as a collectible from the customer. So that's why you want to do it like apples to apples, right? Numerator is sales on credit, and then divided by the balance sheet, which is actually collectible accounts receivable. So what does it say? You have 4 million for Saxton. You have 4 million of credit sales in the given period of time, divided by the amount of receivables of 350,000. So you have 11.4 times of turnover. So this is the number of times of turnover of receivables. Basically, how many times you collected it in a given year? So 11 times. Think about 11 times, 11.4 times in terms of months. So you almost collect it on a monthly basis. So why I said monthly? Because remember, this is actually yearly, right? Yearly or sales is on year, one, say January to December, one whole year. And receivables is the balance sheet as of December 31, 2021. So as of, and then that's actually at the point in time. As of a point in time and then for a period of time. So this one can be expressed in months. So almost every month you collected, almost because it's not completely 12, right? You collected receivables. So when you think about it, receivables, which is 350,000, divided by the average daily credit sales. So what is average daily credit sales? When you think about it, let me just make sure I have that right. Okay, kindly hold, guys, okay? So I use a calculator. I have a old school, I have a calculator always on my desk, right? Accountant. So when you think about it, sales here is annual. 4 million divided by 360 days in a year is 11111. So, or 11,111 daily, because I divide by 360. So that's why you converted the sales into daily by dividing it by 360. So 350,000 divided by 11,000 is 32. So every 32 days, you collected receivable. So that's why it's not really monthly, because month is 30 days, right? So you have 2 days extra multiplied by 2 days over 360 multiplied by 12. That's your point 0.4 over there when you think about it math wise, right? So this is good. Why is this good? Your industry average is 36 days and then you're at 32. But why is it good without knowing the industry average? So a lot of companies would have a credit term. Credit term will be the number of days that you extend to a business before you can collect, right? Think about it this way. If I'm a business, I would want to make sure that uh, I'm secured that whenever I extend credit to you as a customer, you would pay me. So normally you start off with cash on delivery. So if I deliver something to you, then you need to pay me in cash. That should be the rule. Now, what happened is that the more that we have a longer relationship, then I can actually now extend credit to the company, to you, and then your the first credit terms will be 30 days. So some companies would actually say N over 30. So N over 30 means that I will give you credit terms within 30 days. Okay, so that's why if you're paying on the if your customer on an average for the entire company is paying within 32 days, that's give and take almost the same as your N over 30. So that's a good thing. Now, the same thing for the sales turnover. It's sales over inventory, that is 10.8 times a year, right? So it means that you're liquidating the inventory or selling the inventory in a faster rate, better than the one that you have on the industry. Let me just go back there. Now, this ratio might be cost of goods sold. Okay, I'm going to explain this further on a different note. I'm going to show you because I included another slide coming from another book to illustrate. Because depending on the book that you use, it's the same formula, but it might have been described differently. Okay. Now, I'm pulling out this one. This is actually from the Harvard Business School or Business Review, or Business School HBS, and then on working capital. So I always use this one as a discussion point for certain classes, right? There are some finance books that would call so you have turnover and then the period, right? So what do I mean by that? I'm gonna go back just really quick. A turnover, oops, sorry, a turnover and a period. Okay. Oh, that's on receivables, right? So I have the same thing, but now it's expressed as days days sales outstanding or days receivable outstanding. Days sales inventory or days inventory outstanding. I know they have different wordings, but bear with me. You can tell because it's days inventory outstanding, days receivable outstanding. So easy to remember, right? Days payable outstanding. DPO, days payable outstanding, days inventory outstanding, DIO, days receivable outstanding. It can be DRO, DSO, days sales outstanding also. So how does it compute? Remember the daily sales that we talked about on the formula on the previous slide? It's basically revenue or sales divided by 365. In the book a while ago, they divide by 360. So if you have your balance sheet item, which is receivable, inventory, or payable, divided by the daily rate of a receivable, that will be the number of days that you can collect, that you're collecting. So it would equal to the number of days being collected. If it's actually closest to your normal credit term, which is 30, then the better it is. But if this one shows 120, for example, it means that on an average, you collect after 120 days all your credit sales. Not a good thing. Days sales inventory or days inventory outstanding. Remember that cost of sales a while ago in that formula? Let me remind you of that one, okay? here, this ratio may also be cost of goods sold. So this turnover, but the book did not show you the period of time, right? So this is actually the period of time. This is the number of days when you move your inventory. So inventory divided by cost of sales divided by 365, basically converting it to daily. Your numerator is the balance sheet. Your denominator will be the daily rate of the cost of sales. It will tell you now how fast are your inventory is moving. Uh, if it's 30 days, so it means that every 30 days, you completely wipe out and sold all of your inventory, and then you receive another shipment coming from your vendor. Yeah. So why is it important to note? Because that's actually how you do your just-in-time inventory, JIT, inventory management. Why is it important in finance? There is a cost to order and a cost to store, warehousing. So if you've been doing a lot, if your inventory is stuck in a warehouse, it's not moving, it's not being shipped, it's not being sold, it means that it's consuming space. If it's consuming space, you're paying for warehousing fees. You're paying for warehousing fees that are non-moving items. Not a good thing. So that's why the turnover shows you how fast you move your inventory. And then if it's actually a bit too low, say more than 30 days, then you need to think about, am I ordering too much? Am I ordering too much? Or am I ordering enough, but I'm not pushing it out? Because it can be an end-to-end issue, right? So now your root cause analysis or your analysis of why is it actually happening is based on a marker, based on a measurement that you now need to understand so you can control, so you can improve. Given the same discussion that we had on the first with James Harrington, right? Like the one that we talked about. You need to start with measurement in order for you to control and improve, right? Measure, understand, control, then improve. So it all ties up. Days payable outstanding is accounts payable divided by, so what you pay in operating expenses in cash by 365. What does it tell you? How fast are you paying your vendors? Now, if this number, these are additional information, I would say. Most of the items that you're discussing in class or in the book does not include DPO, but it's good for you to know. So what were you trying to do? If I have if I have a DPO number and it shows it's actually say 25. So remember here, if your DSO is less than 30, it means that you're collecting fast enough, right? Because that's your credit term. If this one is 30 also, it means that okay, or less, it's good because it means that you're selling. If this one is also say less than 30, is it a good thing? So it's the reverse. It's not a good thing. Why? If your vendor extended you, the company, a credit term, it means that they would give you, say, 30 days. That's the normal rate, like 30 days for them to collect from you. But if you're paying them in advance, it means that you're not maximizing, you're not stretching the use of the money of the company. What do I mean? I pay on the 25th day based on the DPO on an average. It means I pay too early. If I pay early as a company to a vendor because of an early payment discount, then you're good. If I pay too early just because that's my practice, then it means it's not a good thing because I have another 5 days wherein I can use that money that I pay to the vendor immediately for something else and then still have enough 5 days to collect receivables, to convert it into cash, and then use that money to pay you on the 30th day or the 31st day. So it's all about, so finance is all about managing resources, right? And then how do we know how to manage resources? By computing certain ratios or key performance indicators, KPIs. And one of them is this, okay? So just want to make sure that there is a real world application. We use this one for our company, DIO, DPO, DSO, and then we actually take a look at, especially the DSO, how fast do we collect for our commercial customers, aviation customers, because we sell fuel to them. Now, I'm going to go back to what the content on our book is that, and then I'll explain to you some of the calculation. So you have fixed asset ratio, sales divided by fixed asset. So it means that the fixed asset that you have as of the balance sheet date generated 5 times of revenue. Basically, that's what it is, or revenue, that's what it is, right? So, and then on the industry average, it's generating about 5.4 times. So it means that we're not maximizing the use of the fixed asset yet. So either we need to actually um, think about the depreciation model that we have, think about our acquisition model on how we did, or how are we not maximizing sales based on our fixed assets? I'll make sure that we can trace that, right? I'll go back to our balance sheet, 800,000, because this is actually where the computation lies. So where would that be? It will be on the balance sheet, 800,000. Okay. I want to make sure we can trace it so everybody can know how to compute. And then I'm gonna go here with the, so instead of just the fixed asset turnover, I'll do a total asset turnover. I'm just gonna change the fixed asset to total asset, 1.6. We remember that from the last video. So it's 2.5 times. So this one overall, the total asset of the company generates a lot of uh, sales, 2.5 times higher. It's one times higher than the industry average of 1.5, which is a good thing. Now, so profitability, asset utilization. Now we go to current ratio. Current ratio is current asset over current liabilities. I want to make sure we know what are current assets. Let's go back to the balance sheet, right? So we're seeing here 800,000 current assets. Current liabilities 300,000. Let's go back there. Sorry. This is total assets, 1.6. I only need current. What do you mean? What's again current assets? Current assets actually, as of the balance sheet date, will be 12 months before you can liquidate it all to cash, right? Or you can convert it into cash. So inventory, you just need to make a sale of it and then it becomes cash. Accounts receivable, you need to collect it, then it converts to cash. Marketable securities, you need to terminate it. Basically, it's a placement to the bank, right? Or you sell it. You sell it and liquidate it, then it becomes cash. So that's why this is current. You have 800,000 as current asset, and then your current liability that's due and demandable to be settled within 1 year as of the balance sheet date is 300,000. So this is higher. You have enough current liability for current assets to settle a current liability. So it's a good thing. I'll go back there. Okay. And here, guys. So the industry average is twice as 2.1 times in order for you to be considered liquid. So we say the rule of thumb is actually 2 times, right? You have twice as much current assets over current liability. So here you have more than twice. 800 divided by 300 is 2.67. So you're in a good position. So why is this important? So you think about it this way. In case as of today or as of December 31, 2021, the company will go bankrupt. Do you have enough to liquidate? And then the answer will be yes, the current liability. Thinking about that, let me go back to the balance sheet, okay? Do I have enough current assets to liquidate the current liability? Yes. Do I have enough current assets to liquidate the total liabilities? In a way, yes. But you don't have enough current assets to liquidate, including the stockholders, right? Because it means that you need to settle sell your fixed asset. Of course, selling fixed asset, you could not sell your fixed asset at 800,000. Sometimes it might be a loss. Sometimes it might be a gain, but super small gain depending on the type of assets that you have. So you always think about, if I liquidate, if I collapse the company collapses because of bankruptcy, let me take a look at the balance sheet. Are we good to pay our obligation? Our obligation to current vendors, to long-term vendors, like say banks, right? And then to our stakeholders or shareholders. So the more that we talk about ratios and whatnot, the more that we go in and associate it on how to read the financial statements. So a couple more. Okay, I need to explain this one. So the quick ratio is current assets minus inventory. Certain books calls the quick ratio the acid test ratio, like acid, like acidic, right? So reason why is that, how many times do we need to convert? How many steps do we need to convert inventory to cash? Inventory needs to get sold. It will be an AR, accounts receivable. Then it need to collect it. One more conversion before it becomes cash, right? Unlike AR, you call, hey, can I collect? Then they pay you, one conversion to cash. Marketable securities, I liquidate. I said, okay, I'll pre-terminate. Hey, bank, I'll pre-terminate the marketable securities. Okay, here you go. It now went to your bank account. One step, right? One step only. So take out the two-step, which is the inventory, sometimes including prepayments. And then now it's a quick ratio. So do I have enough? Quick ratio, rule of thumb will be greater than one, right? So you have 1.43. Current ratio, two or more. So you're actually still good. And then Saxon's still better than the industry average. You have 430 liquid current uh, quick assets over the current liabilities of 300,000. Now, the other one will be debt utilization, right? So it measures the prudence of the debt management policies of the firm. Like, are you able, think about the debt ratios or debt utilization ratio as something that the bankers would want to ask you as a company. The banker, of course, would want to get paid, and then they would say, remember that compliance agreement or compliance covenant? So basically, if a company obtains a loan from a bank, the bank will give you a loan agreement. Included in that loan agreement are covenant ratios, or loan covenant ratios. Covenant meaning that you need to abide to them, right? So the bank would say the company should not declare dividends unless cleared with the bank. Because why? The bank would want to be paid first rather than you paying the dividends to your shareholders. Remember that rule, right? Financing, equity financing, you can actually tell your shareholders, I'm not going to pay you dividends, but I need to pay. You need to comply with the payments mandated on the loan covenant for debt instruments or debt financing. Now, debt to asset ratio tells you how much of your assets are funded through debt, about 37.5. Industry is 33, and then you're 37.5. A bit high, you're highly levered. So levered means that you have debt, right? You're highly levered compared to your peers within your industry. Then not too bad, I would say. 7.5 might just be a few mixed, but not too bad. But here's an important one. Income before interest and taxes is 550. How much is the interest expense of the debt, that loan, right? It's 50. So you have enough. So you're able to pay this interest of 50K 11 times. So it means that you have more than enough income before interest and taxes. So that's why it's 550. Where did we get 550? I want to make sure that we can trace it back, because when we do the computation, I would want to make sure that you know how to find it. Here is income, here, 550. Operating profit is income before interest expense and taxes before, right? So it's 550 before. Sorry, I'm going to be moving back and forth, guys, okay? Now, sometimes the company would want to actually see a fixed charge coverage. So this is income before fixed charges and taxes. So it's 600,000 divided by fixed charges of 100,000. So it's actually six times. So it's more than enough to pay for your fixed charges. Let's go and find those fixed charges, 600,000, right? It's actually our income before. So where did we get that 600, that the fixed charges? So this one says that asterisk here, right? On the admin expenses, this includes 50 in lease payments. So that's 50,000 included here. Then interest expense is a fixed charge. So basically you have two, 50 here, and then the 50, this one is actually 100,000 fixed charges. How did we get the interest before income before interest and fixed charges? So you actually have here the 550, which is before interest expense, but you now need to add back the 50 that's included in the 450. That's the reason why it became 600. Okay, the 50,000 here, plus of course the 550, which is already before interest expense. So I wanted to make sure that we are able to trace that. And of course, the explanation is here, right? The 550 add back the lease payments, so it's income before fixed charges. Now the ratio would now look like this, and then Saxon Company, and then this is your industry average, and you can actually have your conclusion. Okay. So I'll show you something that I did before back in the days in Excel, right? But these are dated information, but these are live data. Let me just move my Excel file. Okay. So at one point in time, I was doing some work on a certificate in finance before after my MBA before the DBA. So we're looking at United Airlines. Um, and then these are the modules that we were working on, right? So let me go to financial ratios. So on the financial ratio, we basically did a trending analysis. So I know our next topic will be the trending, right? The trending means that you pull out the financial data and then you analyze, compute the ratios within the company, and then you actually basically trend it from year one, say 2010 is my year one, all the way to 2013, which is at that time the current year. I'm gonna press Control and then there's a bracket next to the letter P. So if I do that, it goes to the source, right? So let me do F5. So this one trick in Excel. So if I press Control, I'm holding Control right now. I know you might not see it because the camera's on my face. And then on the keyboard, there's a letter P, right? Next to it is the one that shows the bracket left side. So I'll press that. It goes to the source, right? If I want to go back to that file or to that tab wherein we actually look at the source, I press F5 and then you basically hit enter. That's it. And now the 0.72 is coming from this side. Yeah. Okay. So F5, then I go back. Why? Because it's actually B19 over B63. So I'm going to go back here. This is B19 divided by B63, which is actually my total liability and stockholders' equity. So that's actually my oh, here's actually total liability. So because it's a current working capital ratio. So here, current assets, current liabilities, that's your current ratio. Quick ratio is basically cash, cash equivalents, accounts receivable, and then divided by current liabilities. Remember, we did not include inventory. And then you do have the times interest earned, and then the debt ratio, and then things that we actually remembered on the, so we call this one efficiency ratio, which we on the book we call it asset utilization ratio. Yeah, so it's also called efficiency ratio. And then you have your return on asset also. So you can actually do that. What we do is that, or what you would normally do is download the audited financial statements of the company. In this case, it's the airline, and then you actually pull it out and then do the analysis. Another one that I was doing before as a coursework, a bit more recent, is for another class that we were doing before. So trending ratio, you can use say from, so I did 3 years, same thing, sorry, profitability, asset turnover, asset utilization, or efficiency ratio. I know it can get confusing, but once you see all the books that you've been reading, is the thing. Efficiency ratio, asset, it's all the same, asset utilization ratio. So you now do the trending. But the trending would only mean something if you're able to compare it with another company. So here, so this one is actually for Apple, based on Apple information. So I downloaded the Apple information online, which they have actually a September uh, cutoff. So what do I mean September cutoff? So their financial reporting is actually every September. Normally, government agencies, federal agencies, have September year end, right? A private company has a December 31 year end. A Japanese corporation has a March 31 year end. So it's a fiscal year, like the government or the federal government has a fiscal year ending September 30, and then everybody else has a calendar year ending um, December 31. I actually have an audit client before hotel. They have an odd one, which is a February 28th, a cutoff every year. So it's a bit different the way that they do their books, but it's still 12 months, but that's their cutoff. So we just need to do some true up with reporting and recon when we do taxes with them. Okay, so FYI. Going back, if I have the same thing, like the current ratio and whatnot, I need now to make sure that I can compare it with Samsung because that's the competitor. I did not pull out the industry average, which might be Apple, Samsung, and then say Huawei, if it's based on all telecom, right? Uh, but if it's based only on certain production of phones, then I might include the others. But if it's based on an ecosystem, so that would be Apple and Samsung comparable, and then maybe one more telecom provider, right? And then now the data, Apple in 2017, the most recent year, is 1.28 current ratio. Samsung is better. Okay, that's interesting. Cash, there's more cash on the Samsung one compared to Apple cash ratio. Profitability, sorry, profitability wise, Apple is higher compared to Samsung by, so for every dollar that Apple sold in 2017, Apple gets 21 cents as a net income. In Samsung, it's pulling out data, that's why it's going back and forth. Samsung gets $17 or 17 cents for every dollar that they sold. So basically, that's how it is when you think about it. Okay. So those are trending ratios, and then I'm gonna move it on the side. Just want to make sure that you can see how is the application for trending. I have also internally that we do, but of course those are were privately held, so I could not share with you the data. But we do the same thing. We format it differently. It's for shareholders, but we do our calculation. I actually have since 2010 data up to 2024 now that we always show um, in the high, like the highest, the lowest, or min and max within those years. Okay. So trend analysis, you actually have it basically trending in on the side, right? Now, impact on inflation on financial analysis. Now, the challenge with inflation is that back in, okay, let's make sure that we have some context on inflation, right? Currently, right now in 2024, I think the federal government recently mentioned that the inflation is about 3%. Of course, the target is 2%, so it's now below 3%, which is a good thing. We've seen as high as 8% at one point in time in Guam. Guam is normally higher compared to the mainland. And then I would say in Hawaii, it might be high also, right? On the state side. Um, so the inflation actually distorts information. Why? When you buy equipment on a certain point in time, during high inflation, the cost of labor is higher when you build something. When you import goods, the cost of shipping, imagine, like, I would say it might be the same in Hawaii or maybe more in Guam, that most of the goods in Guam are actually acquired through shipment. So we don't have much vegetables that are organic or whatnot. We have it on the boat that's sitting for 30 days on the cold storage to go to Guam, including chicken, pork, poultry, or whatnot. So the shipping costs, depending on the inflation during that time, the high inflationary times, would actually be higher when we buy it from the grocery store. So that's why profitability is distorted in a way because of that inflation rate. Certain countries that have hyperinflation, 3 cycles or more, like Zimbabwe. I think you might have seen before. I don't want to say it's a meme, but like they have like the Zimbabwe dollars, like really in millions of Zimbabwe dollars, right? Because of the high inflation rate. So it affects on the way that you normalize the analysis. Now, here, let me just make sure we actually have a discussion on, oops, sorry. I think that will be the last one. Uh, I am gonna just show you a calculation on our trend. So we did a trending analysis. It's basically comparing it over year, and then we have the ratios. So the next video that I'm going to be loading is basically a problem solving exercise, which will also be the basis for your quiz. So make sure to actually watch the third video that I'm going to be loading, which is the calculation part of things. Okay, so I'll see you guys on the next video. Thank you.